The broadcast is now starting. All attendees are in listen-only mode.
Hi, everyone. Thank you for attending our webinar this afternoon, Understanding the Research for Enhancing the Return on Your Equity Compensation Program with Dr. William Castellano. We are ready to begin. I am Virginia with Rutgers School of Management and Labor Relations, and I am your host and moderator. The Rutgers New Jersey, New York Center for Employee Ownership is the proud sponsor of today's webinar, and we have allotted 30 minutes for this presentation. We encourage everybody to send us your questions. To do so, you will click on the orange arrow. You will type your questions into the question box and press send at any time. We will have a question and answer session at the end of the webinar. The webinar is being recorded, and a link to the recording will be emailed to you by tomorrow. It's now my pleasure to introduce our speaker. Dr. Bill Castellano is Chair of the Human Resource Management Department and Professor of Strategic HR Management at Rutgers University School of Management and Labor Relations. He is also the Executive Director for the New Jersey, New York Center for Employee Ownership. An important area of Bill's research focuses on understanding the impact of employee ownership and equity compensation strategies on individual and organizational outcomes. Bill, I'm going to hand this over to you.
Very good, Virginia. Thank you so much. And it's a pleasure meeting all of you virtually for this webinar. Just to go over the agenda that we'd like to cover today, talk a little bit about some of the macroeconomic trends, who owns equity, some data on that, and then get a little bit more into the research of why organizations should think about developing equity compensation programs, also how to improve the return on equity of these equity programs, how to measure this return, and talk a little bit about how perhaps Rutgers can help you understand these strategies and figuring out the return of investments that you have on these programs. So let's jump into economic trends. It's funny, I've been seeing this chart more and more lately. It's a very familiar chart to me, and I've been seeing it, a lot of pundits are talking about it. It's a pretty startling chart if you really think about it. For decades prior to 1980, productivity increases in organizations and income growth have pretty much correlated, mirrored each other. And there has been this classic decoupling around 1980, where now productivity growth and the benefits of productivity have been mostly going to capital and equity holders, shareholders and the like. And it's had a very devastating negative impact on income growth for wage earners within the economy. To look a little bit more specifically about the impact of this decoupling, we're now seeing a phenomenal concentration of wealth, which is pretty startling in and of itself. This chart goes only to 2013, and in 2013, the richest 10% of families owned nearly 76% of the overall wealth in this country. I've been looking at more recent research, and it's now closer to 80%. More startling is the poorest 50% of families in this country only own about 1.5% of wealth. The impact that it's been having on wages has been equally concerning. If you look at this is a chart from 1979, so we're talking about nearly 40 years. The bottom 10% of wage earners have not seen any kind of an increase in wages, in real wages, adjusted for inflation, whereas the top 10% of wage earners have seen a pretty modest increase. And not surprisingly, it's been the top 1% of wage earners that have seen the most significant increases. In fact, as of 2013, the top 1% of wage earners had 22% of the national income. And again, I've been looking at some more research more recently, and it's closer to 24%. So we're pretty much at levels that were right before the Great Depression in 1929. Pretty startling macroeconomic data. A chart that is more specific to the conversation that we're having today highlights the bottom line of who owns equity. You can see in this chart that, once again, the top 1% of households' wealth own nearly 50% of equity, comprised of stocks and mutual funds. Whereas the bottom 90% of households only have about 9.1% of equity holdings. So these are very concerning data for us at Rutgers. We've been researching this for a long time. We've been very actively involved in trying to influence local and federal legislators to address these needs to level the playing field, maybe incentivizing companies to think more creatively about offering these types of programs. Because as we can see, the primary mechanism for individuals to accumulate wealth over the years is through some form of equity capital participation. Let's kind of move into the research on who actually does own equity. Here's some data that is looking at private sector versus government employees. And as of 2014, about 20% of private sector employees had some form of equity. And it's been pretty consistent, as you can see, over the years. We're currently consolidating the 2018 data, so it'll be interesting to see if this is moving up or down. But as you can see, it really hasn't moved much around that 20% mark. Not surprisingly, we see a correlation with size of companies and who owns equity. So employees that are in larger companies, in this chart, 10,000 or more, about 38% of those employees in those companies have participate in equity plans. And then in smaller companies, the participation rates are lower, in this case, 29%. We also, not surprisingly, see a correlation with the amount an individual earns. So higher wage earners, in this chart, we're looking at 75,000 plus. Out of those individuals, about 45% of them do own some form of company stock. Individuals that are making less than 30,000, only about 15% of those individuals are participating in company stock. You can look at these data a number of ways. I mean, clearly people who are earning higher amounts of money have more discretionary income to invest in various forms of equity. It also kind of reflects that some organizations only issue equity for higher paid, typically professionals, managerials, or executive talent, which is why I think the data is skewed. So if the macroeconomic data wasn't enough to convince companies that, hey, this is something we really should be thinking about doing for our employees, it's going to truly benefit them in the long run, the research that we've been doing overwhelmingly supports that there's a lot of good business reasons why companies should think about equity compensation type programs, particularly broad-based programs where many employees or all employees could participate. And we also look at the percent of employees participation in these kinds of programs. And as you can see, the research is pretty compelling. Organizations that have more broad-based type programs, higher participation rates, have much higher productivity rates than organizations that have lesser involvement in equity compensation programs. We see these firms have higher return on equity, much lower turnover, and turnover is pretty much a direct relationship with greater loyalty. So, higher commitment levels of employees result in lower turnover. But we also did a study of organizations coming out of that last Great Recession over 2008, 2009. And what we did see are those firms that are more employee-owned, have higher equity participation rates, had higher survivability rates. They survived the recession. They had much fewer massive layoffs than organizations that had less employees participating in these types of programs. We see individual employees also actively get involved in maybe co-monitoring of fellow workers, more willing to work hard, more suggestions, which can also directly contribute to more innovation. those are kind of classic employee engagement type measures, which we know have very positive organizational outcomes as well. And then another study looking at the higher trust index, which is somewhat of an employee engagement type measure, not surprisingly, also sees that organizations that have higher participation of equity compensation scored much higher on the trust index measure. So a good way to think about this research and putting it into a framework that you can begin thinking about how do I measure the return on equity compensation programs is to first understand that, well, there is this direct relationship between these equity compensation programs and the specific employee outcomes that we've been talking about. And then not surprisingly, companies that have these positive employee outcomes are able to achieve strategic outcomes. In the research that we're quoting today, the strategic outcomes that we were measuring were productivity and innovation. Other strategic outcomes that we've seen also correlated to employee outcomes would be higher customer satisfaction ratings and the like. And then not surprisingly, when organizations achieve strategic outcomes, they're able to have very positive financial outcomes. And in the research that we're quoting here, the measure that was used to measure financial outcomes was return on equity. But that's not the whole story. We took a deeper dive into the research, and we saw tremendous variance among even organizations that had sophisticated equity compensation programs. And organizations that had these, what we would call complementary practices, had even greater employee outcomes, strategic and financial outcomes. The way I interpret these data is these are organizations that have either what we would call a high performance, some would even call an ownership type culture. And if you create this culture while offering equity compensation, your return on those investments are going to be much greater. And the kinds of complementary programs that we see that enable organizations to create this culture, which makes strategic sense for any organization that has broad-based equity type programs, are things such as information sharing, letting employees know exactly what's going on within the organization, the good news, the bad news, what's going on strategically, how are we doing financially, getting employees involved within the organization, making suggestions, helping to make decisions, sharing information and getting input from employees, classic employee involvement type management strategies. Not surprisingly, if you're going to be developing this kind of culture, we oftentimes see organizations empowering employees, expanding their job responsibilities, perhaps giving them more authority to make decisions, as well as actively being involved, as we were just talking about. These organizations also invest a little bit more in training and development. If you're going to be expanding people's positions and responsibilities, it behooves companies to also then invest in training and development, and also job security. Clearly, if we're monitoring the impact that these long-term equity type programs have on employees' outcomes, it makes sense that employees at least have a perception that they're going to be around long enough to see the outcome of their contributions being translated into strategic and financial outcomes. Taking a further look at the research, we did see that there were some other contingencies that moderated the relationship between compensation type strategies and programs and employee strategic and financial outcomes. And a brief summary of some of those contingencies is clearly it makes sense for organizations to continue to pay employees a fixed pay at or above the market, meaning you don't want these equity compensation programs to be a substitution for wage. If you have that kind of a strategy, many of these positive relationships that we've been talking about will not materialize. Not surprisingly, we're talking about a different type of management and supervisory type style. So organizations that have managers and supervisors that are much more participative, managing not in a hierarchical way, but in a more flatter type organizational type structure. So that often means having to train managers or selecting managers that are able to manage in that much more participative form of management. Interestingly, we've been looking at a whole lot of different types of equity strategies and programs, and the combination that had the greatest positive impact were organizations that combined long-term equity type programs with short-term, either a profit sharing or a gain sharing type program. And the combination of those two together clearly had the most significant positive results. It also makes sense to ensure that what we're talking about here is separate from a more diversified retirement plan. And then lastly, and probably most important, is communicating to employees about the risk of equity ownership. And clearly, if organizations are able to grant equity to employees or allow them to purchase at favorable discounted rates, that in effect reduces their risk equity. Organizations that are allowing employees just to go into the market and purchase at market rates will not see these positive outcomes. So you're lowering risk equity, obviously, by giving employees grants or allowing them to participate in these programs at a discounted rate. And that's where we do see these positive results. So when we think about risk, it's really a matter of communication. So it's equally important that companies invest kind of in like financial wellness type programs and let employees understand these risks. And interestingly, the most important risk that kind of highlights the economic data that we were previously talking about is communicating to employees that their biggest risk is not participating in equity programs. I think they need to be educated to understand that, this is how you build wealth over many, many decades. I'm trying to explain this to my 20-something-year-old son that just graduated from college and, explain the power of compounding and, put money into equity today and let it ride for 20 years or 30 years. That's how you build wealth. But equally important is to let them know about, the risk of equity, right? We know equities go up, we know equities go down, and it's critically important not to have any one stock representing more than 15% of your portfolio. And this was more of a problem years ago. A lot of legislation has been enacted that prevents companies to exclusively providing their company stock for over 15% of employees' holdings. But it's something to think about, that they need to have a diversified portfolio if they're going to be actively participating in these types of programs. So we often get questions about, well, where do we get this research from? Well, we participate in all the major national studies. We partner with the National Bureau of Economic Research. We do work with the data from the U.S. Department of Labor. These are huge surveys, so we're very confident with the findings that we have here. You're talking about millions of workers representing a significant component of the Fortune 500 companies. So how do we measure all of these things? So in essence, we're looking at creating valid measures of, first and foremost, I think we always start with the employee outcome measures. And some organizations, and I typically would even advise this, would look at the measures that we include in employee outcomes as an employee engagement measure. So an engagement measure usually is a component of commitment, discretionary effort, maybe their involvement in work. And we know that there's a lot of positive research that demonstrates that an engagement or positive employee outcomes lead to various strategic positive outcomes. So it's important for organizations to think, what are those strategic outcomes that are important to their organization? It may be innovation, it may be productivity, it may be customer satisfaction. and ensuring that you have accurate measures representing those outcomes. And then you want to do a statistical analysis to see to what extent, if my employee engagement index is getting higher, what kind of an impact is that having on strategic outcomes? And then to what extent is that impacting financial outcomes? There are many financial outcomes that people could be looking at. Return on equity seems to be the most obvious one that we're talking about, equity compensation. You can look at it in different ways and say, well, before I look at the relationship between engagement and customer satisfaction, I know that maybe turnover relates to customer satisfaction. And we know that to be true. Companies that have very high turnover typically have lower customer satisfaction indexes. But the real bottom line of these analyses is then to look at these drivers. What is driving engagement and what's driving the strategic and financial outcomes? So you could actually look at, well, here we have equity compensation, what percent of my employers are participating in these plans, and to what extent is that impacting engagement, strategic, and financial outcomes. And then you could actually monitor, well, if I increase that measure of equity comp, it's going to have this kind of a positive impact on strategic and financial outcomes. It's a very compelling way to demonstrate to management the return on investment. And then what are the impacts that these other complementary programs may or may not have within your organization? Typically, involvement, training, information, job security that we've been talking about, in my analyses, it modifies the relationship with equity comp, meaning, we know these relationships with equity comp are positive, but when you include these other measures, the relationship becomes even more positive. And that's a compelling way to perhaps convince management that if we're going to have equity compensation programs, it makes sense to also think about these other complementary programs and then demonstrate by looking at these statistics and measures that it is having a positive impact on the business. So not surprisingly, these data come from employee surveys. And oftentimes, when you're thinking about employee survey, you're not just thinking about equity comp. You should be thinking about measuring these other complementary practices that we've been discussing. So in essence, what you're measuring is to what extent do you have a high performance culture? We're a firm believer that a key component of a high performance culture is an equity compensation type program. So you want to get a sense of what do you employees know about their equity compensation? What are their perceptions of equity compensation? Equally important is to ask questions about the complementary practices and to what extent are they aligned? You may have a company that has high involvement but very low on training, right? That's kind of a misalignment. You want to know, do they understand, meaning the employees, and how they contribute strategically to customer and economic value of your organization? To what extent are they strategic talent? And then equally important is monitoring, do your leaders behave in ways that are sustaining this high performance culture? Are they participatory in allowing individuals to be involved? And then once you collect these data, it's a matter of making sure your measures are valid. We typically do multiple regression analyses to monitor the relationships of the framework that we just discussed. Sounds more complicated than it is, but it's not. The key is to make sure you have enough data to do the analyses. And then more importantly, think about, well, what am I going to do with the result of these data? And that's where strategic decisions and intervention becomes critical. So we've been doing this research for decades at Rutgers, and we recently created the Rutgers Institute on Employee Ownership and Profit Sharing. And under that umbrella, we also established the New Jersey, New York Center for Employee Ownership. So the Institute is more of the research arm. We're the largest research operation in the world. We have over 120 research fellows that we've been supporting for decades. We sponsor about 10 to 20 competitive fellowships per year. We are very much involved in help shaping federal and state policy as a result of the research. We conduct two major research conferences, one in La Jolla, California, one in New Brunswick, New Jersey. And primarily through the center, it's more involved with educating and outreach. We offer an array of training programs. We run conferences and workshops. So for companies that are looking for help, we have volunteer research fellows that can help design, administer these surveys, help analyze your results, but more importantly, after analyzing the results, help develop solutions that can possibly improve your return on investment in these compensation programs. The center, a little commercial, is sponsoring a conference. It's our second annual conference on October 26th. It's going to be here in New Brunswick, New Jersey at the Heldridge. So anybody who's interested today, we would give clearly the early bird registration rate of only $150. So if you go to ownership.rutgers.edu/events, put in Rutgers under the discount code and you'll get the early bird registration. And I'm also doing a similar session, a little bit longer, so I'll be communicating a little bit more research at a session that I'm doing at the Garden State Council of SHRM, which is going to be in Atlantic City on October 14th to the 16th. So I'm going to pass this on to Virginia, who have been collecting your questions, and I'll be more than happy to answer as many questions that you may have. So Virginia,
Okay.
how are we doing with questions?
Okay, we have a first question. It is, do you recommend doing this research when we do our employee engagement survey?
That's an excellent question. And, oftentimes when we're partnering with companies, that's the first thing that I'm actually asking. Are you currently conducting any type of survey or research? And typically it's either an engagement survey or a climate survey. Absolutely, because that's where you typically have many of the complementary type practices that we've been talking about. The perceptions of various HR practices, the perceptions of management and leadership are critical, as we were just talking about. The key is then ensuring you have a valid measure reflecting their various kinds of equity compensation programs, so that you can include that in the analyses that we just described. Good question.
Okay, we have another question. You mentioned the importance of an ownership culture. Can you elaborate on how companies can create such a culture?
Yeah, well, they seem like interrelated questions. Absolutely. Just offering equity compensation, without creating an ownership or a high performance culture really doesn't make strategic sense. So a culture is never going to be driven by just one practice, program, or strategy. How you design jobs, and of course, in the context that we're talking here, when you design jobs to allow people to be empowered and making decisions, that's going to be closer to what we would call an ownership culture. If you're investing in training and development, employees feel that there's a reciprocal relationship, that they're contributing to the organization, but the organization is also contributing to my success, and it makes me equally productive within the organization. That contributes to an ownership culture. And then, of course, how are you measuring performance within the organizations? I mean, there needs to be a strategic component to every employee's performance objectives. And it's the classic cascading balanced scorecard. To what extent is my individual performance impacting my group and department and organization's performance as it relates to a customer satisfaction measure or a financial measure? We classically call that a line of sight. Do employees have a line of sight in understanding how their individual contributions impact the organization. That's a key component of an ownership culture. And then clearly having the right type of management and leadership that encourages involvement and information sharing and the multitude of things that we talked about previously. But my key point is that it's a system that needs to be aligned. And if it's not aligned, if you're only doing one or two of these things and not another, it's kind of like a chain with, the chain is only going to be as strong as the weakest link. And the synergies of having an aligned system of all these progressive practices will clearly enhance the relationship of equity compensation with these various employee strategic and financial outcomes.
Okay,
Good questions.
Thank you. We have another question. Do you have data you can share on whether a stock grant or reduced stock purchase plan is best?
Well, a stock grant, as I was saying before, has a very positive impact because there's, in essence, really no Holly risk equity. It's above and beyond what people are typically being paid. So any kind of a grant is going to have a much higher or more significant impact on these measures that we've been talking about.
Thank you. So that was our last question. If anybody else has any questions that you would like Bill to answer, please feel free to send them to me. I can forward them to Bill and we will get them answered for you. So this concludes our webinar for today. Thank you everybody for joining us this afternoon. Bill, thank you for this very informative presentation. For more information about the Rutgers, New Jersey, New York Center for Employee Ownership, please visit our website, ownership.rutgers.edu. It's a great resource. Not only does it have information about our upcoming events, but it has publications and also all of our past webinars. Recordings of all our webinars are there as well. So do check it out when you have a moment. So thank you again and have a good afternoon.
Thank you.